Greg, welcome. Good to have you with us. How difficult is the needle that Mr. Powell must thread? Is it harder even than the needle he had to thread or what he had to do at the height of the pandemic 2 years ago when when the economy rolled over?
Well, they're two very different situations, Tyler. 2 years ago, when the pandemic first hit, we were back into dynamics that were not that different from the financial crisis, with a non-economic, or I should say a non-traditional economic event, essentially causing confidence, employment, everything to collapse. And the Fed basically acted in an emergency situation, doing a lot of creative things, and then guarding against the possibility of a very weak recovery, much like we had after the crisis. In retrospect, that perhaps was taken too far, and so they've been caught off guard by not just a very strong recovery in demand, but also significant and lasting constraints on supply. And the result is that you see this big gap opening up between what people want to do and spend and what the economy seems to be able to provide, and the result is very low unemployment and very high inflation, and the Fed completely positioned incorrectly, with the federal funds rate still at zero and them still buying bonds. They need to reverse course and reverse course very quickly. And doing so without doing a lot of damage either to the markets or the economy is a huge challenge.
Yeah, it's a huge one. And you didn't even get to the question really of labor and labor shortages. And if those persist, in other words, if people continue the, quote, great retirement or continue to stay on the sidelines because they don't like the job opportunities that are out there, that is going to put more pressure, upward pressure on wages. Not a bad thing for workers, but ultimately it contributes to inflation and it carves away at corporate profits.
Right. And I think this is where the Fed is really behind the eight ball, because they were thinking that they could recreate the pre-pandemic period where unemployment got down to the low 3% area, and this would gently contribute to wages and inflation. Instead, we got the 3.9% unemployment, a full percentage point lower than the Fed thought we'd be a year earlier in the month of December. And we're going lower. If you look at the Fed's forecast, they're looking at 4% GDP growth this year. That's consistent with the unemployment rate dropping into the low threes. Now, if we're seeing the kind of inflationary pressures and wage growth that we're seeing at 3.9, imagine what we're going to see when it's down in the low threes. So that really just, I think, illustrates, Tyler, how sustained this pressure is that the Fed is going to have to combat. What they're hoping is that a lot of the restraint on the supply of workers is a temporary factor related to COVID. And as COVID retreats, we'll see people flood back into the labor market. Unemployment won't fall so fast, but we'll still create a lot of jobs. That's kind of the baseline, but I think with each passing month, that baseline looks a little less likely.
This is so interesting, because it does all come down to how many people come back in the labor force. And in a way, that's more of a fiscal policy issue and a pandemic issue, isn't it? So what should we watch? And if people don't come back in the labor force, where is this economy heading?
Well, you know, Kelly, this week we're going to get another CPI print, and the consensus is it'll be around 7% year on year, like a really ugly number. And the Fed's message and the White House's message all along is this is mostly reflecting temporary shortages. And to a certain extent, they're right. I mean, used cars have doubled in price, and that's clearly not because the labor market is tight, right? I think the question is, once some of the more obvious labor shortages are out of the way, like with used cars, like perhaps with ocean-going shipping, where are we? And that's where the job situation comes into play. If inflation, if those temporary factors fall away, and that leaves us with, say, inflation in the 3 to 4% area, then an unemployment rate in that scenario of the low 3% area is not consistent with inflation going back to the Fed's target. And that's where you get into some of these difficult questions. How tight does the Fed have to get? And I will say, that was one of the more interesting takeaways, I think, from Powell's testimony today. He did not at all basically close the door on the possibility of actively selling bonds off their balance sheet, an accelerated form of quantitative tightening. And he talked about the possibility of having to raise the federal funds rate into restrictive territory.
Shepard Smith here. Thanks for watching CNBC on YouTube.